The TSX has approximately 40 publicly traded REITs. When you read a Canadian REIT article, the same three names appear: RioCan, Smart Centres, Allied before it ran into trouble, sometimes Canadian Apartment Properties, sometimes Boardwalk. The same names, the same analysis, the same conversation. Here is what that conversation is not covering. A Canadian Industrial REIT that reported 12.2% FFO per unit growth in Q2 2026, with 98.1% occupancy across 61.5 million square feet of logistics and warehouse space, that has raised its distribution for 15 consecutive years, and carries one of the most conservative balance sheets in Canadian real estate. Almost never mentioned. An industrial REIT that just reported 10.3% comparative properties NOI growth, with 21% weighted average rental spreads on leases, meaning existing leases are renewing at 21% higher market rents, driving embedded organic income growth with no new acquisitions required. CPP Investments, one of the most sophisticated institutional investors on the planet, bought a portfolio of its assets as a joint venture partner. First distribution increase in 13 years just announced. Almost zero retail investor awareness. And a net lease REIT, whose primary tenant has been operating in Canada since 1922, carries an investment-grade BBB credit rating, signs triple net leases requiring it to pay property taxes, insurance, and maintenance on every property, so the REIT collects near-pure net rent, with a 10-plus year streak of consecutive distribution increases and a $330 million development pipeline funded entirely by retained cash flow. Almost nobody in Canadian retail investing has ever researched it. 3 REITs, 3 completely different categories, all overlooked for label reasons, not fundamental reasons. Granite REIT is a Canadian-based REIT that owns, develops, and manages logistics, warehouse, and industrial properties across North America and Europe. 145 properties, approximately 61.5 million square feet of leasable area, a $9.6 billion portfolio spanning 6 countries: Canada, the US, Austria, Germany, the Netherlands, and Spain. These are the physical assets of modern commerce, the warehouses where online orders are picked, packed, and dispatched for next-day delivery, the logistics hubs where retailers and manufacturers manage inventory, the industrial facilities where supply chains begin and end, unglamorous, essential, difficult to replicate, impossible to relocate to a cheaper jurisdiction. Q2 2026, published August 6th. FFO per unit was 1.56 Canadian dollars, a 12.2% increase year over year. Same property NOI grew 8.3% on a constant currency basis. Committed occupancy, 98.1%. Leasing spreads in the quarter, 7%. On leases expiring in 2026, management expects average rent increases of 20% to 25% as below-market leases roll to current market rates. The 5-year FFO per unit compound annual growth rate, 10.1%. 2026 full-year guidance, FFO per unit of $6.25 to $6.40, representing 6% to 8% growth over 2025. Same property NOI growth, guided at 5.5% to 6.5%. The balance sheet. Net leverage ratio, 31%. That is among the most conservative in Canadian industrial real estate. BBB High credit rating with a stable outlook, investment grade. The combination of high occupancy, growing rents, conservative leverage, and investment grade credit gives Granite a financial profile that most Canadian REITs do not match. The distribution record: 15 consecutive annual distribution increases. 4% raise for 2026. The distribution has grown consistently through multiple real estate cycles, interest rate cycles, and economic cycles. A 58% AFFO payout ratio means the distribution is well covered and has room to keep growing. The Magna update. The historical concern about Granite has been its tenant concentration. Magna International has been a significant tenant. The recent development: Magna is committing to longer-term leases. Longer lease commitments from the anchor tenant reduce rather than increase the concentration risk. This is a positive development for the concern most commonly raised against Granite. Why nobody talks about it? Institutional warehouse real estate is not exciting. Most Canadian REIT content focuses on apartments, retail plazas, and office towers, the properties people interact with daily. Nobody drives past a Granite logistics facility and thinks about the REIT that owns it. The result: a REIT with 15 years of distribution growth and among the strongest Q2 2026 operating metrics in Canadian real estate, sits almost entirely outside the retail investor conversation. The honest risk: some analysts estimate the stock may be trading modestly above its net asset value. Industrial real estate vacancy has been rising in some North American markets as the post-pandemic logistics boom normalized. Granite's 98.1% occupancy is strong, but the broader industrial market bears watching. Investors should monitor occupancy and leasing spread trends in coming quarters. Dream Industrial REIT owns high-quality industrial properties across Canada, the U.S., and Europe. 348 industrial assets, 565 buildings, 75.7 million square feet of gross leasable area. Core Canadian markets include the GTA, Kitchener-Waterloo, and Montreal, three of Canada's most supply-constrained industrial markets, where new supply is limited by land availability, zoning, and construction costs. Q2 2026. Published August 4th. Comparative properties. NOI growth of 10.3% on a constant currency basis to $103.7 million versus $94.0 million in Q2 2025. Diluted FFO per unit of $0.28, a 7.8% increase year over year. FFO payout ratio lowered to 63%. Available liquidity, approximately $750 million. Leverage, 35.8%. Over 3 million square feet transacted year-to-date at a 21% weighted average rental spread. That 21% rental spread is the most important number in Dream Industrial's story right now. It means that when existing leases expire and get renewed at current market rates, Dream Industrial is achieving rents approximately 21% higher than the previous lease. This is embedded organic rent growth that does not require a single new acquisition. The income from the portfolio the REIT already owns is growing substantially simply because below-market leases signed years ago are rolling to today's market rate. Two specific leasing wins in the quarter: a 265,000 square foot 10-year lease with a blue-chip global automotive company in Cambridge, Ontario, bringing that property to 100% occupancy. And post-quarter, a binding lease for 127,000 square feet at the recently completed GTA East Whitby redevelopment project. 2026 full-year CPNOI growth guidance was raised to 7% to 8%, up from the 5.7% growth achieved in 2025. The CPP Investments Validation. During Q2, Dream Industrial completed $370 million in asset dispositions, the second tranche of a joint venture sale to CPP Investments. CPP Investments is one of the most sophisticated institutional real estate investors in the world. When they buy your assets at a negotiated price, they are validating the value of what you own. This is not a distressed sale. It is a strategic partnership with one of Canada's most credible long-term investors. The distribution milestone. The 2.5% distribution increase announced with Q2 2026 results was the first distribution increase in 13 years. This is not a weakness. It is a signal. For 13 years, management prioritized balance sheet strength, debt reduction, and portfolio quality over distribution growth. The decision to raise the distribution now, with FFO growing at 7.8%, a 63% payout ratio, and $750 million in liquidity, reflects management's genuine confidence in the durability of the cash flow trajectory. The naming problem, Dream Industrial REIT and Dream Office REIT, are entirely separate entities in entirely different property categories managed under the Dream brand. Dream Office faced significant post-COVID challenges as office occupancy declined. Dream Industrial is performing at a high level. Many Canadian retail investors conflate the two and never look closer. The name is the obstacle to discovery, not the fundamentals. The honest risk. This was the first distribution increase in 13 years, meaning the distribution has been flat for over a decade before this raise. Investors expecting consecutive increases going forward should note that the historical track record is one of stability, not growth. Also, real estate leverage at 35.8% and meaningful European exposure introduce currency and market-specific risks. Here is the vault. The Canadian REIT, whose primary tenant pays the property taxes, the insurance, and the maintenance on every single property it leases, leaving CT REIT to collect what amounts to near-pure net rent from a company that has been operating in Canada since 1922. CTREIT owns retail properties leased predominantly to Canadian Tire Corporation under triple net leases. Over 90% of its annualized base rent comes from Canadian Tire. That is the single-tenant concentration that most investors immediately cite as a reason not to look further. But the triple net structure changes the risk profile dramatically. In a standard commercial lease, the landlord pays property taxes, building insurance, and maintenance costs, and deducts them from gross rent to arrive at net operating income. In a triple net lease, the tenant pays all three. CTREIT's operating cost exposure is minimal. The income it collects is close to pure net rent, predictable, consistent, and largely insulated from the cost inflation that erodes margins in other property types. The tenant quality argument. Canadian Tire has been operating in Canada since 1922. It carries a BBB investment-grade credit rating. It has approximately 1,700 retail and gas locations across the country. Its product mix, automotive, sporting goods, home products, apparel, serves everyday Canadian spending categories. Its Triangle Rewards loyalty program drives repeat visits. The standard objection to CTREIT is single-tenant concentration risk. The relevant question is, how likely is Canadian Tire to materially fail, vacate properties, or stop paying rent in the next 10 to 20 years? The answer to that question, based on 100 years of operating history, investment-grade credit, 1,700 locations, and no viable direct challenger in its niche, is the complete response to the concentration risk objection. This is not a guarantee, no investment is, but the concentration risk framing obscures what it actually describes. Very long-term commercial relationships with one of Canada's most established retailers. The distribution record and financial profile. Consistent distribution increases every year since the 2013 IPO. 10-plus consecutive years. Annual distribution growth rate, approximately 3.7% consistently. Cash flow payout ratio, 50.7%. Well covered, with meaningful room to keep growing. Interest coverage ratio, 3.7 times, strong. AFFO per unit growth, consistent year over year since 2014. A $330 million development pipeline funded entirely by retained AFFO. No dilutive equity issuance, no new units issued to fund growth. Yield, approximately 5.6% to 5.8%. The honest risk? The single-tenant concentration is a genuine structural feature, not just a perception. If Canadian Tire were to face severe operational or financial distress, CTREIT's income would be materially affected. The 100-year operating history and investment-grade credit rating reduce this probability. But investors should understand it is a real structural characteristic of this REIT, not one that disappears because the tenant is well known. Additionally, CTREIT has limited analyst coverage and relatively low trading liquidity compared to the largest Canadian REITs. 3 REITs, 3 property categories, 1 connecting thread. All 3 are overlooked because of label problems, not fundamental problems. Granite is overlooked because Warehouse REIT is not an exciting label, and industrial real estate generates almost no retail investor coverage. Dream Industrial is overlooked because the Dream brand carries an association with Dream Office that does not apply to its industrial portfolio. CTREIT is overlooked because Canadian Tire Stores sounds unexciting, and the single-tenant structure triggers an objection that most investors do not examine closely enough to understand. The operating metrics tell a different story. Granite, 12.2% FFO growth, 98.1% occupancy, 15 consecutive annual increases, 31% net leverage, BBB High credit, Dream Industrial, 10.3% comparative NOI growth, 21% rental spreads, CPP Investments as a JV partner. First distribution raise in 13 years from a position of strength. CTREIT, 10-plus consecutive years of increases. 50.7% cash flow payout. Triple net leases. A tenant operating since 1922 with investment-grade credit. $330 million self-funded development pipeline. None of these are magic. All 3 carry real risks, named honestly in this video. None are guaranteed, but all 3 are overlooked for reasons that have nothing to do with the quality of the underlying business. That is the distinction worth understanding before dismissing them. 3 Canadian REITs that almost never appear in Canadian investment content. Granite, 15 consecutive annual distribution increases, 98.1% occupancy across 61.5 million square feet of logistics space, 12.2% FFO growth in Q to 2026, BBB High credit rating, 31% net leverage. The most fundamentally sound industrial REIT in Canada by most metrics, and one of the least discussed by retail investors. Dream Industrial, 10.3% comparative NOI growth, 21% weighted average rental spreads driving embedded organic income growth, CPP Investments as a JV partner validating asset quality, first distribution increase in 13 years, signaling management confidence, $750 million in available liquidity, 2026. N.O. Growth guidance raised to 7% to 8%. CTREIT. Near pure net rent from triple net leases. Primary tenant operating in Canada since 1922 with BBB investment grade credit. 10-plus consecutive years of distribution increases since 2013. 50.7% cash flow payout ratio. $330 million self-funded development pipeline. Consistent 3.7% annual distribution growth. These are not recommendations. They are introductions. Every one of them deserves a position on your research list, particularly if your current Canadian REIT exposure starts and ends with RioCan and smart centers.